Hi, so today the topic is divisional performance in management accounting. How would we calculate a divisional performance within an organization? Divisional performance is basically comparison of ratios between organizations' divisions. We can use ratio interpretation or financial analysis for calculation or comparison of ratios between the divisions in an organization. Could be A, B, C, or between an organization's current year or previous year, or with competitors of the organization, or the industry in which the organization is actually the industry in which the organization represents. Now, the key area of divisional performance is to highlight the difference between manager performance and divisional performance. A manager performance can be calculated, but before we go on to manager's performance, we need to know the difference between two kinds of expenses: controllable expenses and non-controllable expenses. Controllable expenses are expenses that are in control of the management of that division. The management has control over certain expenses and certain revenue that the manager is overlooking in that division. If the management has control over the expenses, the management is said to have authority and responsibility of those expenses. Based on that, we can calculate the controllable profit. A controllable profit is the controllable revenue that the management has generated minus the expenses that the management has control over to give a controllable profit. Controllable profit is the profit that the management can be responsible about. The management is not responsible for any other expenses that is outside its responsibility range. That brings us to non-controllable expenses. Non-controllable expenses are expenses that are mostly, as written here, given to the division by head office. These are expenses that are allocated by head office to different divisions based on their divisional performances. Okay. Here we have a format of the division. Revenue sales less variable cost or cost of sales gives us contribution or gross profit. Less fixed overheads gives us controllable profit. So the first step is to calculate the controllable profit. As highlighted in yellow, that means that this actually shows the manager's performance of the division, right? And if you deduct it by the head office expenses are those that are not controllable by the management. These are expenses that have been allocated by the head office that the manager should not be responsible about, should not be asked about. This then gives us the division's profit, overall profit within the organization, right? Now, to calculate the ratios or to calculate what kind of divisional performance tools can be used, we have two major ratios written here: return on investment and residual income. Let's look at return on investment first. Return on investment gives you the formula net profit divided by capital employed. Capital employed is basically called, in other words, net assets. Net assets can be calculated by using the formula total fixed assets plus current assets minus current liabilities. Or the other side of the balance sheet is equity plus long-term liabilities. So if you want to calculate the return on investment, what does return on investment actually depict? Return on investment is basically the net profit that has been generated on your asset base, on the net assets. Capital employed. Capital employed, in other words, can also be called as the capital of the company or the finances of the company. Capital employed, as we can see here highlighted in green, is equity plus long-term liability. Equity means that your capital must either be financed by equity or must have been financed by debt, or the combination of both, or either one of the following, right? So capital employed is technically the capital or the finance of your organization. So to calculate how much revenue or profit has been generated on those capital gives you the return on your investment. Now, if you want to differentiate between the manager's return on investment and the divisional, so you will have to replace your net profit by either the controllable profit to calculate the manager's performance and division's profit to calculate the divisional performance. So the only difference that is created by understanding the manager's performance or the overall divisional performance is the profit, net profit, that you're going to use in the equation of return on investment. The second is called the residual income. The residual income is basically, what does residual actually mean? Residual is actually the leftover income. A residual, the remaining income, right? How can you calculate a remaining income? So what happens is, every division or organizations working have to pay off to their debt holders, to their shareholders, either preference shareholders or ordinary shareholders. So residual income actually calculates how much income of a division is left after paying off its debt holders and its equity shareholders. So the formula for residual income is net profit minus cost of capital into capital employed. Cost of capital is actually also called a WACC. WACC, cost of capital, is the cost that has been generated based on the capital that you have. So capital is divided either into equity or debt. You have equity shareholders, you have debt shareholders. So the cost is actually what you're paying to these finance strategy to generate these finance. Equity holders are paid in the form of dividends, and debt holders are paid in the form of interest, right? So the cost of capital is a combination of dividends and interest, which you have to pay based on your capital employed. So the net profit minus this gives you the income that is left. Higher the residual income, that means better the performance of that division is. Also, higher the return on investment, higher the net profit generated by the manager and the division as a whole, better the performance of the division as a whole, right? So residual income and return on investment are one of the key ratios to calculate a divisional performance. So we can also differentiate between manager and divisional performance using controllable net profit, where manager performance is calculated, and using divisional net profit, where divisional performance is calculated. Other than these two ratios, we have other ratios that can be used that we've been doing since ages. The first and the most important is the net profit margin ratio, which is calculated as net profit divided by sales. Then we have the GP margin ratio, which is the gross profit, or we can call it the contribution to sales ratio as well. Then you have the total controllable expenses to total sales ratio, or we can have expenses to net profit. And then one of the most important ratios is also called the asset turnover ratio. Asset turnover ratio is also sales over capital employed. We have a DuPont analysis, which mostly is used. DuPont analysis basically explains us that we can identify a single ratio by multiplying two ratios. That is, ROI that we discussed in the first place can be calculated by net profit margin ratio multiplied by asset turnover ratio, right? How is that possible? What was the ROI ratio? In the first place, we identified ROI as net profit or capital employed. So NP divided by CE is calculated also as NP divided by sales into sales divided by CE. Looking at this, you can see that the sales can be cancelled out and you will be left with NP over CE. So DuPont analysis is a very nice analysis that you can also calculate ROI directly by using the margin and the asset turnover ratio. The key behind the asset turnover ratio is that it gives you, it explains whether the organization is generating enough revenue with its capital base or not, right? So it is similar to the ROI ratio. The only difference is the ROI calculates how much profit is generated based on your capital employed, on your assets, and the asset turnover gives you how much revenue is generated on your asset base. So that is all about divisional performance for today. Welcome, Management Accounting. we'll be doing a tutorial based on divisional performance, which we did last time. So this is a continuation of the divisional performance, which is transfer pricing and EVA. What does EVA stand for? Economic value added. Economic value added, what does it actually mean? It means that we're going to look at the financial statements from the perspective of economists, right? So we've done accounting, we've done financial reporting, but what we have done is we've looked at the overall scenario with the bird's eye view and with view of accountants. But today EVA is all about looking at the actual substance rather than its form, right? So if you remember that we did historical cost accounting. Historical cost accounting is basically based upon the accounting concept, whereas EVA, so let me write it down, HCA, which is historical cost accounting, is based on the concept of cost accounting, and we're going to incorporate inflation to get to CVA and CPP. So this was a concept that we did in reporting. This is exactly what we're going to apply to economic value added. So economic value added means we are going to see adjustments in our net profit to identify the economist view, right? So before we move on to that, I'm typing the residual incomes formula, which is net profit minus cost of capital into capital employed. EVA is based on the same formula. The only difference is that the net profit is not net profit, it is adjusted net profit minus cost of capital into adjusted capital employed. Now, the only difference between these two is the adjustments, right? So what kind of adjustments are we talking about? So there are two kinds of major adjustments that we're going to look at today. So these are the adjustments that we're going to make to the net profit and to the capital employed to actually understand what economic value added means. So the first adjustment that I've written down simultaneously is research and development. So we're going to look at it in two perspectives, accounting profit and so let me just write it down, R&D. So accounting profit in accounting terms, we're going to see, so the economic view. So now we're going to divide it into two views. So in an accounting profit, in an accounting view, research and development is taken as an expense in the income statement, right? As I've written it down here. Now looking at the economic view, what happens is that economists say that research and development actually gives you a product that reaps future benefits to the organization. So it is not an expense technically. Research and development gives you future economic benefits. So we are not going to look at it as an expense. We are going to look at it as a capital item. Why? Because future economic benefits means that you have capitalized or made an asset out of a research and development. So the development is of a product that was actually reaped a future income into the organization stream, right? So that is why we are going to adjust a research and development as per the economic value added EVA view. So the EVA view, I'm going to explain again, differentiates its accounting view and its economic view. The accounting view's adjustment that I'm going to write down now is that in net profit, we are going to add back the R&D expense that was already expensed out. So we are going to adjust it how? We are going to eliminate its impact from the net profit. And in capital employed, as I've written down, we are going to, as we are capitalizing it, we are going to add it as an asset in capital employed, because now this is the true economic value of it. As an asset, because it is now an intangible asset, we are going to obviously mention it at its net book value according to the financial accounting. And so we're going to deduct its depreciation both in the asset and in the net profit. So again I'm going to repeat what we did with R&D. So we created two areas, accounting profit and economics view, and I've written capitalize here because we've capitalized it as per the economic view. So if you could see the formula, the capital employed and NP, net profit, were both adjusted for R&D from its accounting view to its economic view, right? So in the net profit, we're going to add back the research and development and deduct its depreciation because it is now an asset. And in the capital employed, we are going to add the non-current asset and deduct its depreciation and calculate its net book value. So if you could see the formula for EVA, which I've highlighted, now we've adjusted the net profit and we've adjusted the capital employed. We are going to follow the same formula for EVA. Looking at the second adjustment, which is also a major adjustment, is training cost. Similarly, a lot of economists view that training costs are not is not an expense, because training leads to the similar scenario created in research and development. It creates a skill in an employee which then reaps future economic benefits to the company. So I'm copying pasting the same accounting view and the economic view and the accounting treatment and the EVA treatment that we did in R&D, and I'm going to replace it with add training cost. I've written it down as TC. It's not that what you think. Anyways, so and then we're going to add it in a non-current asset because we've capitalized the training cost, because this is something that developed the skill. But because it's an intangible, so I'm going to write amortization instead of depreciation. So I've copied it both ways. So non-current asset minus amortization gives you the net book value of training costs. And in net profit, you're going to add it back and you're going to deduct the amortization associated with it. So this is basically the two main adjustments that we did in EVA to net profit and capital employed. If you remember that in divisional performance, we did residual income. The formula for residual income was net profit minus cost of capital into capital employed. I'm not going to go into the detail. So EVA is exactly the same concept. The only difference between residual income and EVA is that we're going to adjust the net profit and capital employed based on the economist views, based on the views that gives you substance over form, that what is the real substance of these two accounting methods over the form, right? So the third area that we are looking upon is now internal goodwill. What is internal goodwill? Internal goodwill is actually your image, your brand, your asset, which you capitalize, right? Which you tend to capitalize. It is an intangible asset. So what happens is that sometimes companies tend to expense it out, or sometimes they do not capitalize it, right? So in that case, when companies think that internal goodwill should not be capitalized, it should be expensed out. Why? The reason being that internal goodwill duplicates the value of other assets, of other intangible assets, right? So if let me just so in research and development, as I'm highlighting, we expensed it out, we capitalized it. Again, I'm going to format it a bit. So in R&D, I showed you the table explains the major adjustment, right? So similar is the case with internal goodwill. As in internal goodwill, what happens is that in that case, the adjustment to the net profit and capital employed is the opposite of research and development, right? So in this case, in internal goodwill case, I'm not going to stress more on that. Why? Because it's a very minute detail. Coming back to internal goodwill, you will deduct the expense from net profit and you will deduct the net book value from capital employed, right? So in this case, what we are doing is we are going from an asset to the expense. And in research and development and training cost case, we were going from an expense to asset, right? So I've deleted the internal goodwill because it's not part of your syllabus, but I just wanted to explain to you how we can have two portions of EVA where your asset, your expense becomes an asset, as I've highlighted, and your asset can become an expense as well, right? So this is all about EVA, and now the next concept that we're going to go to is transfer price. This is the second last area of divisional performance. In divisional performance, we've looked at divisional performance itself and different financial ratios. We've looked at EVA, and third one that we're going to look is at transfer pricing. Now, why am I emphasizing a lot on divisional performance and transfer pricing and EVA is because what I think that transfer pricing with EVA has not been tested, and I have a feeling that this time it's a very red flag area that it can be tested in this examination by the examiner, by the University of London examinations, right? So that's why my emphasis is on the divisional performance area, that they can give you at least two questions based on divisional performance, NPV IRR, which is capital appraisal techniques, and then they can give a separate question based on transfer pricing and EVA, right? So what we're going to do is we're going to look into the concept of transfer pricing, and we've already seen the concept of EVA last time. So this tutorial will consist of only transfer pricing, and what we're going to do next time is we're going to do a unique question which was given in again 2015 zone B paper that we're going to do in the next class, is based on transfer pricing and EVA combined. I've never seen a question like this. It's either based on transfer pricing or the question is based on EVA separately, but in this paper the examiner has combined the both. So what I'm doing with you is, as you all know, is we are doing unique questions. We are doing questions that are technically difficult, so that if we do difficult questions, when the easier question comes in your exam, you will already be prepared for a higher difficulty level, and the exam questions in your actual exam will look easier. So that's my main aim for all of the students, for all of you in management accounting, right? All right, let's start off with the concept of transfer pricing. So transfer pricing is basically based on the concept that we have three or more different divisions in an organization. The divisions could be in different countries, the divisions could be in same country, but different let's say cities, right? So these two could be the scenario, and in such a case, what happens is in transfer pricing, that one company, let's suppose, so I've made a table on three divisions A, B and C. So we have product X that we're going to focus on. So we have A. A means that A is manufacturing X, right? B is the main raw material for B is X, which is RM, and it manufactures another product, let's say Y. And C, the division C, has also and needs the raw material product X, and it manufactures something else from that product, which is Z, right? Okay. So now what we're going to see is, the dilemma here is, we have one division manufacturing a product which is needed by division B and division C, right? But the dilemma is whether A should provide the product to B, or provide it to C, or provide it to both. And if it does provide it to B or C, and B and C, what is the cost at which B and C will purchase that product from A, and vice versa, what is the selling price that A is going to charge B and C for that product that it's manufacturing, right? That is where transfer pricing comes into place. Now, before we move on to the calculative part of transfer pricing, what we're going to see is the two major rules on which transfer pricing is based. Number first is called goal congruence. Goal congruence means individual goals should not exceed organization goals. Goals means objectives. So the main aim of transfer pricing is not to create animosity between the three departments, but to create an atmosphere where all the three departments think and make decisions in a way that benefits the organization as a whole, not themselves individually, right? So that is the key area of transfer pricing, that A, B, C need to make a decision of the product X that they want in such a way that neither one of them are at a disadvantage, and that there is a whole and that all the organization benefits from each individual decision, right? The second rule of transfer pricing is profit maximization. Individual divisions, if they maximize their profit, their overall profit will be maximized. So two things that we're going to look at in transfer pricing is, number one, what was the objective of transferring the product? Number two, what is the profit calculation before the transfer and after the transfer of product X? And did the before transfer and after transfer create an increase in profit, or was there profit maximization that took place or not? If before transfer the profit was lower and after transfer the profit was higher, then yes to transfer price. But if the profit was higher before the transfer and it was lower after the transfer, then the transfer should not be done. Now this profit is all in terms of organization profit, not individual profit. So what happens is that we are going to look at the organization's profit as a whole, which is a combination of all the divisions' profit together, right? Alright, now coming on back again to the transfer pricing calculation. What we are going to do is, what the examiner wants from us is that we want to know what transfer price should be charged to B and C so that the profit and the goal congruence is met. The two rules of transfer pricing are met. Now let's suppose, I'm going to give you an example here. Let's suppose product X is sold internally by A and externally, right? It costs A a variable cost of 10 per unit, and fixed cost of producing X is 15 per unit. So let's say the total cost, I'm going to write 10 here, I'm going to write 15 here. So the total cost for manufacturing X by A is 25, as we can see in the sum, right here. So yeah, I'm so sorry, I've mentioned it already. I thought I hadn't. So the sum, or I'll say total cost, is 25 per unit, right? And let's say that A wants to sell it at 35 per unit to external market. Now B manufactures Y, but it needs raw material X to manufacture Y. And the market price where B is, so let's suppose I'm going to give three areas. So let's suppose A is a US based division, B is a Poland based division, C is, let's suppose, Australia based division. So you have three different divisions, right? So what we're seeing is that B is in Poland, right? And C is based in Australia. So we are looking at division in different countries. I'm going to highlight that. So B, where it's operating, the market price for, we are going to, in transfer pricing, in management accounting, we assume that we've converted the currencies at a similar rate. So basically, if Poland and Australia are different divisions, we've converted it to dollars. So all the values that I'm suggesting is based on one currency, that is dollars, right? So if the market value of purchasing raw material X in B is $40. So at what price should B purchase it from A? Now A already has a very low market price. So let me just increase it, let's say to 45 per unit, right? So if A has a market, external market, where it can sell it to 45 per unit, if it sells to B at 45, let's say, I'm going to write it down here. So let's say A sells B at 45 per unit. Is it going to be beneficial for B to purchase it at 45 from A? No, because B can purchase the same product in its market for 40 and it can save $5, right? But again, in this case, B is looking at itself individually, and the key of transfer pricing is goal congruence. So B needs to make a decision that does not impact its individual profit, but it should impact the overall organization's profit in a better way. So let's move on. We have different transfer prices that we're going to discuss. C, let's look at C. C also purchases X and manufactures some other item known as Z, and its market price for X is $35. Now, it's not going to purchase it for 45 from A at any cost, because it's going to lower its profit margin, correct? So now the key here is what? Now the question mark. What is the price at which A should give B and C the raw material X that B does not put itself at a loss, and A is not at a loss as well? So now we're going to come at different types of transfer pricing. That's where different types of transfer pricing comes into play. So we have 6 kinds of transfer pricing, as I've written here. The first kind of transfer pricing is transferring at market price. What is the market price? The market price of A. So all these transfer prices are written down in terms of A, not in terms of B or C, because A is the division that is actually manufacturing it and transferring it. So A needs to also see that it fulfills its cost so that it is not at a loss, and B and C needs to see that at least A tries to make it below their market price so that it is beneficial to them to purchase it from A. Otherwise, they won't bother by purchasing it from A. They would purchase it from their own markets, right? Alright, so the first price is market price. So A is selling it at a market price of 45. So it will sell it to B at 45 and C to 45. But in this case, what I'm seeing is that in this case, the overall organization profits are going to fall, because as we will compare it with the before transfer, again this rule applies here. So we have to be very careful what we are going to do and what transfer price policy should be devised by the organization. So what does the organization does is it creates a before transfer price profit and it creates an after transfer price profit. That is exactly what your examiner is going to ask you to do. The first question that the examiner will ask is, what is the profits of the 3 divisions before transferring of any product? And then the second question is, calculate the profit based on the transfer price suggested by the organization themselves. And the third question asked by the examiner is, what do you think, which transfer price will lead to the ultimate profit maximization, right? So if we see, the market price is not a very good transfer pricing, because in this case usually B and C would be at loss if they have a lower market price as compared to A's market price. But if B's market price and C's market price is greater than the selling price of A, then market price can be a better option. Then we come at full cost. Full cost means adding variable cost plus fixed cost. So in this case, in A's case, its full cost is 25 per unit. If A transfers if A transfers product X at 25 per unit, it's going to be very profitable for B because it's getting it at less than its market price, and profitable to C as well because it's getting it at less than market price. but it's not going to be profitable to A because its A's profit margin goes to 0 if it sells the product at the same price that it cost A. That means A is not making any profit out of it. Again, we will have to compare the before transfer and after transfer profits of all divisions individually and the organization as a whole. So how do we calculate the profits of the organization as a whole? I'm going to explain it quickly here. What we're going to do is we're going to create a total here, and then when we calculate individual profits, we're going to total it at the end, right? So they're going to be an individual profit, they're going to be an organization profit, and that's how we're going to compare which transfer price is better. The third is variable cost. This is the minimum transfer price. You cannot go below that. Why? Because if A sells anything below its variable cost, its contribution is negative, and you don't want any division's contribution to go negative, right? So A will only sell it to other divisions only if it has a positive contribution, and this is only the case where A creates a rare product that B and C cannot find in their markets, and A has to sell it to B and C at variable cost so that B and C do not have to pay a higher price for a unique product, so that it remains within the organization and the profit remains within, right? So this variable cost is actually known as the minimum transfer price, right? Now let's come to negotiated price. Negotiated price, what actually does negotiated price mean is that the managers of each division will negotiate the transfer price with A. So A is the key player here because it's obviously providing the product needed by B and C. So transfer price at negotiated price, what does it mean? Let's look at it. So the B's market is 40. A's selling price to its market is 45. So B would say, okay, let's negotiate a price in a way that it does not, A gets a certain profit markup from the price, and the price is lower than the B's market price. So if they negotiate a price at $35, that means that A is making a profit of 10 per unit, right? It is obviously lower than its external market price, but still they're making a profit. And the profit is greater than what B is losing here. So B is basically gaining, sorry, not losing. B is gaining $5 per unit from its market because its market is giving it at an expensive price as compared to A. So it's gaining $5 here and A is gaining $10 here. So this becomes a very ideal circumstance where B and A are both getting profits based on a negotiated price. Also, let's come to C. So let's say C says that my market price is 35. So if you could give me a price at 30, so let me highlight it in a different color. So if you could give me a price at 30, I would save $5 per unit and you would be earning $5 per unit as well. You are not going at a loss, right? So A is gaining a total, so A is recovering its full cost and gaining a $5 per unit profit. So A says, okay, we can work this out. So a negotiated transfer price between these two divisions is, one, it is negotiated, two, they're both different. So if the transfer price is different for both division, we call it dual pricing. We call it negotiated with dual pricing. That is, you're charging different price to different division. Let's suppose A charges C 35 as well. So we would call this negotiated. We would call this negotiated only. Now there is no dual pricing taking place because A is selling its product in equally on equal price to B and C. But if C gets it at 30, then it becomes negotiated with dual pricing. So we've understood dual pricing as well. The sixth point is opportunity cost pricing. This is not as such in your syllabus, but we're going to look at it with a question that we're going to do. So what the key thing that we've seen here is that the goal congruence only works where without transfer price profit is less than with transfer price profit. That is exactly what I explained here, right? So what happens is that in an organization, mostly negotiated pricing prevails, because in that case a manager has an authority and responsibility of its division. So if they make the division's decision based on that division's performance, because if you remember divisional performance, manager's performance is equally important and we need to see its controllable profit. Transfer pricing is something that comes in the controllable profit. So if managers make a decision, they will have to be responsible about it. So in this case, negotiated pricing prevails mostly in most countries, other than market price and full cost, which is also a part of decision making. Transfer pricing set by the organization's head profit at in certain times when the product might be unique, the product might be rare, and there may be other circumstances where market price and full cost are used. So the most important area of transfer pricing is its calculation. The calculation has to be done in such a way that the country or the division selling the product should always be labeled first, right? And the ones purchasing the product should be labeled afterwards. So we're going to do a question on transfer pricing in EVA, which is 2015 Zone A, which will actually clarify how the format of transfer pricing is actually carried out. But for today, I just wanted to explain you the main concept and what are the major rules of transfer pricing and what are the major types of transfer pricing and how you're going to calculate different transfer prices and how you're going to make a decision based on this table. So I'm going to highlight this table because this table is the most important to make a decision whether to transfer or not, right? I will be seeing you in my next tutorial session where we will be doing the question of transfer pricing and EVA. Till then, if you have any questions regarding transfer pricing, regarding divisional performance, regarding EVA, regarding NPV, regarding capital appraisal, please let me know.